Disclaimer, this video is for informational purposes only and does not constitute financial advice. Always do your own research before investing. In a world spinning with inflation, market crashes, and political uncertainty, one question keeps coming back stronger than ever. Is Bitcoin just a risky bet, or is it becoming a strategic part of a modern investment portfolio? Today, we're diving into real data, not just opinions, to discover whether Bitcoin deserves a spot alongside stocks, bonds, gold, and real estate. Stay with me, because the numbers might just surprise you. Let's start with performance. Pure and simple. Since 2015, Bitcoin has delivered over 17,000% returns. Yes, you heard that right, 17,000%. Compare that to the S&P 500, up just 214%. Gold has barely moved by 48%. And US 10-year bonds, a sleepy 19%. But hold on, 2025 has shaken things up. Gold is having its moment, up 30% year-to-date, setting fresh all-time highs. Meanwhile, Bitcoin is down about 4%, sliding between $102,000 and $89,000. Yet even in this volatile year, the iShares Bitcoin Trust, or IBIT, has outpaced gold ETFs, growing 116% compared to just 68% for gold. Now, let's talk about something even more important than raw returns: risk-adjusted returns. Because high returns don't mean much if you can't sleep at night. Bitcoin's 3-year Sharpe ratio now stands at 1.85. That's better than the S&P 500's 0.92, and even gold's 1.03. And here's a shocker. During the chaotic April 2025 market crash triggered by new tariffs, Bitcoin's short-term volatility actually fell below that of the stock market. Yes, Bitcoin was less volatile than the S&P 500. But what about diversification? Is Bitcoin just another risk-on asset, or can it actually protect your portfolio? The answer? It depends on when you look. Bitcoin's 60-day correlation with the S&P 500 swings wildly, from negative 42% to positive 78%. During bank crises and market panics, Bitcoin tends to move independently, even opposite, to stocks. But when liquidity floods the system, it moves together with risk assets. Gold, on the other hand, stays more predictable, but less powerful as a true hedge. Let's move to the big debate. Which is the better inflation hedge? Bitcoin, gold, or real estate? Since the money printers turned on in 2020, Bitcoin has exploded 623%. Gold, a modest 14%. Real estate, about 42% gains based on the Case-Shiller index. Fast forward to today's 4.1% inflation environment. Bitcoin-backed bonds like Bitbond are up 18% year-to-date. TIPS, inflation-protected treasury bonds, are barely at 2.3%. Meanwhile, rising mortgage rates have hammered commercial real estate, driving REIT prices down 12%. Now let's talk liquidity and access. Bitcoin settles over $50 billion every single day, with average fees so low you'd barely notice. Transactions are confirmed within minutes. Gold ETFs, they take 2 days to settle. Real estate? Well, good luck closing a property sale in less than 45 days. And that's before paying 5 to 6% in commissions. And retail investors know it. In 2025, 23% of new capital flowed into crypto, compared to just 11% into stocks. But it's not just retail investors moving in, institutions are too. BlackRock's 2024 white paper now recommends a 1 to 2% Bitcoin allocation for diversified portfolios. According to their models, adding just a sliver of Bitcoin could boost returns by 3.2%, while actually reducing portfolio volatility by 8.7%. Even Yale's legendary endowment fund allocated 6% of its assets to crypto by 2023. Bitcoin is no longer just for the tech bros, it's becoming a mainstream institutional asset. Of course, every opportunity comes with risks. Bitcoin faces regulatory pressure, especially from new MiCA laws in Europe. Custodial risks are real, even with cold storage solutions. And geopolitical shocks remain unpredictable. Bitcoin rallied 18% during the Russia-Ukraine crisis, but dropped 9% during the April 2025 Taiwan tensions. Also, mining centralization is creeping in. Today, just 3 US companies control over 55% of Bitcoin's total hash rate. So what's the right move? For conservative investors sticking to a 60-40 stocks and bonds split, adding just 1% Bitcoin, maybe through the IBIT ETF, could boost returns without blowing up risk. More aggressive investors might consider 5% Bitcoin exposure, alongside 3% gold, and 2% real estate crowdfunding. In times of extreme fear, when market volatility soars, Bitcoin has shown to act as a surprisingly strong hedge. So here's the bottom line. Traditional assets, stocks, bonds, real estate, provide stability. Bitcoin offers something different: asymmetric upside. If timed carefully, with an optimal 1 to 5% portfolio allocation, Bitcoin isn't just a gamble, it's a powerful strategic diversifier. Ideal entry points sit below $85,000. And if Bitcoin's weekly RSI ever shoots past 85, that might be a good time to lock in some profits. Gold still holds a timeless charm for inflation protection. But in today's fast-paced, hyper-connected markets, Bitcoin's liquidity, transparency, and institutional momentum give it the edge. For portfolios under $10 million, Bitcoin is no longer a fringe idea, it's becoming a core building block. Thanks for watching. If you found this breakdown helpful, hit that like button, and subscribe for more real-world data-driven investing insights. Remember, in investing, knowledge isn't just power, it's protection. See you in the next one.